What's up, Kevin? Hey, hit the request to join button. I don't know if you can hear me. Hold on. Um, well, hey, there he
Hey,
is.
what's up, man?
What's up, man? How you doing?
I'm good. I'm good. How are you?
Awesome. I'm doing good, man. I can't complain. Oh, wait. Let me move this around. Hold up. All right, there we go. Yeah, man, I'm doing good. How you doing?
I'm good, man.
Awesome. How's your day been?
Busy.
I believe it.
Had a closing today. Took in 3 apps today, so it was a good, productive day.
Nice, man. I'm glad to hear that.
Yeah. How about
Definitely
you?
good. It was good. So yesterday I had a closing. It was actually my mom's closing, and I was able to. So my parents are out of town on vacation,
Okay.
so I went to the closing for her and everything like that. And it's always nice to see people,
Sure.
at the closing when they get their keys. They're super excited, even if things didn't. It was a little
Right.
shaky, with
Yeah,
the
yeah, yeah,
closing
yeah.
sometimes. But once they get those keys, everything is
Nah, this
good.
is the,
So.
the, the keys are the cure, man.
Oh, absolutely, man. It was nice. I mean, it was her first time buying a house, and it was you could just feel the vibe from her that it
Yeah.
was a very big accomplishment. She was super humble. So even though I wasn't necessarily her agent, but I got to be a part of it. So, for me that was a huge win.
That's what's
So
up, man.
yeah, I enjoyed it a lot. But yeah, so it's been good, man. And today I'm actually after this, I'm gonna go meet up with her and hand her the key since now everything's recorded and she's officially a homeowner.
Yes, sir.
So yeah,
Yes, sir. That's what's up, man.
awesome, awesome, man. Well, let me check real quick because I don't even know if anybody responded. I know I put in the stories that I was gonna be going live with you, so let me see real quick if anybody responded with questions. But overall, I know I said I was gonna send you some questions, but instead I just want to keep it super organic.
Yeah,
We'll
yeah.
just
I
have a
kept looking for him. I was
conversation.
like, I guess we just gonna roll with it.
Yeah, we just gonna wing it, man. We just gonna wing it. So,
It's all good.
um, I figured that'd be a little bit better. I didn't want it to come across like it was, pre-scripted or anything.
Yeah.
But
Nah, we
well,
can
yeah,
roll
I
with
didn't
it.
get any questions, so we're just gonna dive right into it. But so overall, I know we got a few people that joined. Looks like Miss Smith joined and Premier Exec joined. Thanks for stopping in. But overall, yeah, man, I just wanted to, kind of talk about with you being, I guess, introduce yourself first for the people that don't know you.
Sure. Name's Kevin Bullock. I'm the branch manager at Crown Home Mortgage, located in Cary, right on Kildare Farm Road. Been in the industry now going on 18 years, and absolutely love what I do, helping people get into homes. We're building out, we're branching out. We got new loan officers that has just joined on board, and we're doing our part to educate and encourage as many people as possible to get into the home ownership game. So just having
Yeah,
fun with it,
definitely.
man.
Nice, man. It's always good when you can have fun with,
Yeah.
with your career. So I'm a real estate agent, Eric Rainey, broker here in North Carolina. I know a lot of people. I work with first-time home buyers. I work with people that have bought multiple homes. I work with, all different kind of mortgages as far as, whether it be FHA, VA, conventional loans, whatever it is, I help buyers get into the house or sell their house, anything real estate related, kind of do that for them. So I know when it comes to first-time home buyers, I get asked all the time, Eric, what's my first step? So I'm always telling them they gotta talk to a lender, somebody like you. Yeah,
Yeah.
exactly. I'm like, you gotta talk to a lender so we can go out and look at houses. So, I actually have a lot of people here lately who have been hitting me up and they're like, Eric, it's my first time buying a house. I don't know what to do. So, from you being on the lender side, on the mortgage side, what do you tell people like, hey, first step, you need to do this, second step, this? Like, I mean, even before they talk to you, like what kind of documents do they need to bring to you? Just kind of on their side, what do they need to have in order for you from when that first meet happens?
So yeah, so I tell everybody too, I'm really the first line of defense in this home buying process, right? And it's funny, a lot of people bypass the lender and go straight to the realtor because when they go online, most of the time they start online, and then the realtor's information is there, and they're looking at properties and things like that. But they don't realize that you're just going to turn them right back around and say, "Hey, have you spoken to a lender? Have you been pre-approved?" Because you want to make sure you're looking at something that you can actually purchase.
Right.
So when I'm talking to a first-time home buyer, one of the things that I tell them that we're looking for, I call it the CIA, right? It's credit, income, assets, right? So
Okay.
first thing we're looking at the credit. The credit tells us basically your willingness to pay back debt.
Right.
If you're purchasing a home, that's going to be a large piece of debt, a good debt, but it's still debt. The way we determine whether or not you can afford that and your likelihood to repay that is we start looking at your credit history. So we're looking at the credit report. We're looking at how you've been maintaining your credit over the past year or so. And then
Right.
we're looking at the scores. Scores are not always indicative of what you've been doing lately. Sometimes the scores haven't caught up to some of the due diligence that you've been doing. But that's what we look at. We review it. We figure out ways to, if we need to increase the score, what do we need to do? What do we need to get it up to? So that's the credit piece. Then we're looking at the income. Are you employed? How long have you been employed? What type of work do you do? Because we're looking for stability. You're taking out a 30-year mortgage, 15-year in some cases. So we want to make sure that there's some job stability so that, once you purchase this house, you can keep the house, right?
Right.
So we're looking at the income. And then we're looking at the whether it's through stocks, cash, a gift. Do you have enough money to make the transaction happen through your
Hmm.
down payment, through your closing costs, through other incidentals that you need, such as appraisal, inspections, due diligence, earnest money, right? These are all of the things that we're going to go over. So I'm typically asking people for, pay stubs, bank statements, W-2, so that we can verify, the credit, the income, and the assets.
Yeah. So, quick question for you. So, when you said, well, I got two questions actually. So, you said credit, CIA. So when it comes to credit, what are you looking for as far as like what's the minimum score? Is that just like one bureau or is that across all three? How does that work?
So now they kind of changed the laws a little bit. So in some cases, they're actually now starting to do an average of the three.
Okay.
But just to keep things simple, you have three scores, right? You have TransUnion, Equifax, and Experian. And typically, you would take the middle score. So your
Right.
highest and your lowest gets tossed out. Whatever that middle score is, regardless of the bureau, whatever that middle score is, that's what we'll use. I think
Okay.
now it's the lower of the two. So it could be that middle score or the actual median, uh, trying to make things a little bit more of an even playing field as far as the credit's concerned.
Right.
When we're talking about what's the lowest score, technically, you can go down as low as 580. I don't suggest it, right? Because as you go down in credit score, what you're basically telling me as a lender is I'm a higher credit risk. So the lower the score, the higher the risk. Well, like anything else, if there's a high risk, then the requirements are going to change. So you may be required to put a little bit more money down. You may be required to have some reserves. Your debt to income ratios may not go to the max. So you're going to be limited in your purchasing ability the lower the score. So 580 is the lowest. We can go down to 580. We do have some options. I say if we can get your score 640 or above, it just starts to open things up more for you.
So that's kind of the magic number, 640.
Yeah.
I got you. Okay. And you also mentioned pay stubs. So I was speaking with somebody recently and she actually I've heard this a lot. So, hey Eric, I just switched jobs. I make a bunch of money now. I should be able to afford X number dollar worth of house, right?
Right.
But I've been there for 2 months. So how does that work if somebody, especially with the pandemic going on, everybody, the great what is it, the Great Quit or the Great Resignation. So with
Hmm.
so many people switching jobs right now, how does that work out for, verifying income, and how does that affect their ability to get approved?
So it can affect it uh, sometimes in a negative way, but it really all depends on what the total story is, right? So yes, we don't like as lenders, we don't typically like when there's some switching of jobs or employment. We do like pay increases. So if there's if you're switching jobs and your pay went up, that's not necessarily a bad thing. We just need to know what the story is. So you have a client, they've been working in the field of nursing, they just landed a job at a different hospital, making more money. They've only been on at this hospital for 2 months. We
Hmm.
can use the new job as long as there's no large gap in between employers. Okay.
What
Uh,
what would be a large gap?
so a
Like
large gap is anything over 6 months.
yeah,
Uh,
that's a big gap.
yeah, that's a large gap. I mean, if we still have to explain 1 month, 2 months, but those are a little bit more explainable, right? You're looking for a
Hmm.
job, you have to go through the hiring process. It is what it is. But now, when you start going over 6 months, that's when it starts to get a little tricky. Also, very important in the switching of jobs, if you're going from W-2 to W-2, many times there's really not too much frowning on that. You just went from one job to the next. As long as we can collect the 2 year work history, we should be okay. Where we get into problems is when you have somebody who's been a nurse for the last 10 years and now they decided to do their own in house practice and now they're self employed. Now we can't use the 2 year history because you went from W 2 to 1099. And
Right.
so in that case, now we have to wait and get 2 years of 1099 income in order to qualify you. So if you're going to switch jobs, you want to stay within your pay type, W-2 to W-2, or if you're self-employed, you're staying self-employed. But once you switch and you go from W-2 to 1099 or vice versa, that 2 year waiting period starts from the time you start.
Hmm. Okay. Yeah, I went yesterday and got a haircut, and my barber was talking about his approval process for his mortgage, and or yeah, I'm pretty sure it's his mortgage, not refinancing. But anyway, he was talking about he had to produce all these different, documents and papers and everything like that. It was way different. Um, as far as income goes, like kind of what's the base? Like I mean, if I'm making $25,000 a year, would you even consider me, or would I need to start like 30, 40, 50 before I would even be able to be, considered for a basic mortgage?
So I would say it depends on what you're trying to purchase, right? So
Okay.
uh, your income level is your income level. So I would never tell somebody if they make 25,000 that's not enough, right? I'm going to ask you, what is your budget as far as where you want your mortgage payment to be? Because what we do in qualifying and ensuring the eligibility of a borrower, we're looking at their debt to income ratio. So let's just say the debt to income ratio, or DTI, you may hear us professionals say, right? The DTI is
Right.
50%. We're going off your gross monthly income. So if you're making 25,000, you're making what, a little over $2,000 a month gross. 50% of that is $1,000 without any debt. So your mortgage payment really could not exceed $1,000. Now, if you add one car note, we're through the roof already on the
Hmm.
25,000. You know what I'm saying? So,
Yeah.
so it really all depends on what you're looking to purchase, how much debt you have. That's going to let me know how much income you need to make. So you can have two people. They both make $50,000. One has student loan debt, a car loan, and credit cards. The other person has no debt. The person with no debt, even though they make the same amount of money, the person with no debt is going to be able to afford more house because his
Hmm.
debt to income ratio is going to be lower. So it really,
Okay.
we got to look at the whole scenario and really see. I would say, depending on what market you're in, we're in this triangle market. So having a $25,000 income may not cut it in this particular area. You may need a cosigner in that
Hmm.
regard,
Right.
or unless you're putting down a hefty down payment,
Hmm.
sometimes that can cure some costs as well.
Got you. Speaking of down payments, here recently I've had a lot of people hit me up, especially with it being the holidays. Everybody wants to save their money or be able to spend it on gifts, things like that. Um, Down payment assistance programs, no money down home purchases.
Right.
Can you tell us a little bit about, some of those kind of programs that are out there and what it takes to even qualify for those and how you're able to buy a house without putting any money down?
Sure. So first, I always lead. Whenever I get asked this, I always lead with this: there's no such thing as free money. Right.
Right, right.
Right. There's no such thing as free money. So if you're
Yeah.
getting your down payment or your closing costs covered through one of these programs, you're paying for it in some way, whether it's through rate or it's through origination fees. Some way, somehow, there's a cost to not have to put any money down. So, with that being said,
Real quick. So
sure.
when you say origination fees, so like for people watching this and people that watch it later, never bought a house before, they understand rate, but they might not understand what origination fee is. So what is an origination fee?
So, origination fee can really, depending on the lender, they can kind of disguise different things, but really, as it pertains to this, like down payment assistance or DPAs, that's going to
Right.
be in the form of like points. A
Okay.
point is when uh, there's a percentage of the loan amount that's tied to the rate,
Hmm.
and you pay whatever that percentage is. So I tell people too, I can basically give you any rate you want within reason. What are you willing to pay for it? Right? Because
Got you.
every rate has a cost. Well, if you have a down payment assistance program, many times they build the cost into the rate and they charge you an origination fee to originate the loan. They charge you a fee, and usually that fee is dictated by whatever rate they're giving you, and that's how they're able to offset paying your down payment.
Hmm. So really, it's all going to cost you the same. It's just where the numbers lie.
Correct. Either you're going to pay
Okay.
for it up front or you're going to pay for it over the course of time. But you're paying for it. That's why I said there's no free money. It's not. Oh
Yeah.
yeah, we're going to give you $10,000. That sounds great, but if your interest rate goes from 3.5 to 4.75, you're paying that 10,000. You're just paying it over time.
Gotcha. Okay. Um, so I mean, being that you're on the lending side, I mean, you get to see the rates and the numbers and everything like that. As we're coming into, 2020 is going to be here in no time. We're a few weeks away.
Yeah,
I was actually
crazy.
reading something I know this year flew by, but they're talking about the rates going up and, what are your thoughts on that? I mean, where do you see stuff being in 2020? Because I have a lot of people that are asking me, hey, Eric, should I buy a house now? Should I wait? Everybody, I want to wait for the market to calm down, which in the triangle, unfortunately, I mean, we got all, well, not unfortunately, but fortunately, we have all these different tech companies that want to come here. Apple's coming, we have all this stuff going on. So housing here is just, for me anyway, my mindset is that the numbers are going to continue to go up. I mean, nationally, they're predicted to go up, what, 16% next
Yeah, I'm gonna
year over
say
the course
about
of
15,
20.
16%. They're looking at increases.
Yeah, so it's like if you wait, you end up buying, let's say you're approved for 300,000. 300,000 today is, let's say it's a four-bedroom house, right? But 300,000 in the middle of 2022 may be a two-bedroom house
Right.
because you waited.
Correct.
And then on top of that, it's looking like the rates are going to go up too.
Correct.
So, like, where do you see that going in the next 6 months, 12 months?
Well, the rates, if you notice, the rates are starting to creep up now. Like the
Hmm.
rates on average are higher now than they were 6 months ago, 3 months
Right.
ago. The rates,
Yeah.
you're starting to see a slight uptick in the interest rate. Now, we've been spoiled, right? The rates were so low for so long that we've kind of been spoiled, but the rates aren't bad. They're still low. I'm like, we're still giving rates out in the mid to low threes, high threes, right? So we're still under 4 in many cases. But I really believe that over the next 6 months, you're going to start to see a taper off of the rates, slight upticks, maybe a little bit more. So you'll see anywhere between 3.5 and 4.5. I think that's going to be the overall spectrum of interest rates, and that's going to be contingent on credit score, property type, whether it's a primary or an investment. That matters. But yeah, definitely not waiting. That should not be. If you can purchase now, right?
Yeah.
Like I said, appreciation, house prices are still going to go up. Interest rates are going up. And I tell people, this is not the 2007, 2008 market. Like, people are
Right.
thinking that
Yeah.
it's going to crash. I was in it
Hmm.
during that time. I remember that very well. And
Yeah.
that market is completely different than this market. This market is really economics. It's supply and demand. We have less inventory than buyers. So the demand for the properties are going up. Now we're
Hmm.
starting to have, we went a whole year. Nobody was building, nobody was moving, nobody was selling, right? 2020
Right.
kind of put a stop on a lot of things. And it
Right.
started making people think, right? With COVID and the pandemic, people was getting off the fence. They didn't want shared space, so they wanted to purchase their own properties. You have
Hmm.
people now realizing that they did not have to stay in a certain area to still work at their job, because now there's a hybrid schedule. So now people are a little bit more flexible in moving. So now that things are starting to open up, we're still short on inventory, but the buyers are increasing. And like you said, in this particular area where we are in the triangle, we have big tech companies coming. Apple, Google, like all these companies are coming, and they're coming with higher paying jobs. So the values are going to go up because they can afford it. So this is
Hmm.
not like it was, 2007, 2008, and you're waiting. I'm just going to wait for all this to die down. I think you're doing yourself a disservice.
Yeah. Yeah. I agree with you on that one. I It's interesting because, like, when you look at 2007 was fueled by the banks, that collapsed. This one
Mm-hmm.
is just supply and demand issue.
Correct.
So it's very different compared to what, a lot of people, when I talk to them, they're like, it's gonna crash. It's a bubble. Da da da. But then if I ask them why is it a bubble, they can't really answer that question. Not from a very smart, with analytics and numbers to prove what they're
Right.
saying. It's just a feeling.
Right.
Awesome. What else should we know about the mortgage process and about the different types of, loans that are out there,
Well,
especially for somebody that is their first time buying a house?
I would say there's really 4 program types, right? You have USDA, which is
Hmm.
really geared towards a specific area. You have to be in a more agricultural area. Doesn't have to be
Hmm.
complete farmland, but it's definitely outside of city limits.
Right.
So that would be like a USDA loan. Then you have VA. So if there's anybody watching that served our country, first of all, thank you for your service. But you
Yeah.
may qualify for a VA loan. Then you have FHA and conventional, which are 2 of the more common loans. Uh, the difference really between, and I'll just for the sake of conversation, right, just stick with FHA and conventional, since those are the 2 more prevalent loans to choose from.
Okay.
Uh, FHA has a tendency to be called the first time home buyers program. It's really
Hmm.
not a first time home buyers program. It caters to many of the needs and challenges of first time home buyers, meaning they allow for a low down payment, 3.5%. They allow for a higher debt to income ceiling. So uh, conventional will cap you anywhere between 45 and 50%. FHA, in many cases, you can go above 55%. So, it gives you a little bit more threshold as far as your debt's concerned.
Hmm.
They're a little bit more lenient on the credit scores. So that
Hmm.
580 that we were talking about, that between the 580 and the 640, you can get an FHA loan in that. You're not going to get a conventional loan with a score that low. So
Right.
even though it's not technically a first-time homebuyer program, many times first-time homebuyers, their challenges surround credit, income, maybe higher debt. And so FHA sometimes seems a little bit more palatable for them. Conventional, conversely, is a great program. I think you, as a realtor, I'm sure you see it's the preferred program, right?
Oh
And
yeah.
for many different reasons, but they're a little bit more strict as it pertains to credit. They're a little bit more tight as it pertains to debt to income ratios. The minimum down payment for a conventional loan is 5%. There are some 3% programs, but you have to qualify for that, meaning they cap your income. So if you want a 3% conventional loan, many times your income can't exceed a certain number. And then there are some other ways to get in there, but again, that will be based off a conversation you have with your lender. But that's
Right,
really
right.
the difference between the two. It comes down to down payment, credit scores, and property type. Another big thing to realize, FHA is solely for owner occupied properties. So you
Mm-hmm.
can't purchase an investment property with an FHA loan. You have to live
Mm,
there. So when I say owner occupied, you as the owner of that property, you have to live in the property. Conventional can go either way. You can purchase as an owner occupied or an investment or a second home. So
mm-hmm.
conventional gives you a little bit more flexibility in what you want to actually do with the property as well.
Right. So, because I do have people that are asking me about being able to buy a space, right? But they don't want to live in it. They just want to rent it out. So they need to go conventional.
Right. If they have no intentions on living in the property, they absolutely need to go conventional.
Okay.
USDA, VA, and FHA, those are all government backed programs. So those programs are going to require you to live there.
Okay. Gotcha. Yeah. You don't want the feds coming over,
No, sir.
knocking
No,
on your
sir.
door. Do you live here?
No, sir. We don't
All
want
right.
that.
I activated my dog. He over here barking now. He thinks somebody's at the door. Awesome, man. Well, hey, I know you said you got something else you gotta do tonight, so I ain't gonna keep you up here too long.
Yeah,
But
I got a one of my loan officers is doing her first homebuyer seminar, so I just want
nice.
to pop in and kind of help out if anybody has any questions.
Yeah.
But yeah, this was awesome, man. I can't wait to the next one.
Yeah, man, we gotta do this like, I don't know, every week or something. We got a lot
Listen,
of people got
I'm
a lot of
for it,
questions,
man.
so
I'm for it.
awesome. It's good conversation for sure. I guess, close us out with something mighty, some words of encouragement, something that somebody needs to hear today.
Listen, I would say don't let anything stop you from purchasing. If you have a goal to be a homeowner, don't let anything stop you from achieving that goal. You have awesome professionals like Eric, like myself, that are willing to educate you on the process. If you have a question, ask. Many times we may know the solution to that problem. Many times it's not as bad as you think, right? I get a
Right,
lot of people that say, "Oh man," when I ask them, why you haven't purchased it now?" Like, just I was a little bit afraid I might get denied. Listen, if you get denied now, it doesn't mean that it's going to always be that way. We just might need to put together a game plan, right? We just
right.
talked about it. It's
Yeah.
already almost the middle of November, right? It
Hmm.
seemed like we
Oh
would
yeah.
never get out of 2020, and now we're about to
Yeah.
go into 2022. So time
Right.
is moving. So let's put together a plan. Call Eric, call myself. Let's put together a plan. Let's get you into a home. Let's start building generational wealth. And it can start with you.
Hey, there we go. Couldn't have said it any better, man. All right. I appreciate you joining, Kev. I'll talk to you later.
All right, no problem, man. Take care.
All right.